Hi ladies and gentlemen. Welcome to channel Digital Trader. In this video we will discuss about behavior of stock price. Nasdaq in Times Square, New York City. The efficient market hypothesis (EMH) is a hypothesis in financial economics that states that asset prices reflect all available information at the current time. The hard, efficient market hypothesis does not explain the cause of events such as the crash in 1987, when the Dow Jones Industrial Average plummeted 22.6%, the largest ever one-day fall in the United States. This event demonstrated that share prices can fall dramatically even though no generally agreed upon definite cause has been found. A thorough search failed to detect any reasonable development that might have accounted for the crash. Note that such events are predicted to occur strictly by randomness, although very rarely. It seems also to be true more generally that many price movements beyond those which are predicted to occur randomly are not occasioned by new information. A study of the 50 largest one-day share price movements in the United States in the post-war period seems to confirm this. A soft EMH has emerged which does not require that prices remain at or near equilibrium, but only that market participants cannot systematically profit from any momentary market anomaly. Moreover, while EMH predicts that all price movement, in the absence of change in fundamental information, is random, i.e. non-trending, dubious, many studies have shown a marked tendency for the stock market to trend over time periods of weeks or longer. Various explanations for such large and apparently non-random price movements have been promulgated. For instance, some research has shown that changes in estimated risk, and the use of certain strategies, such as stop-loss limits and value-at-risk limits, theoretically could cause financial markets to overreact. But the best explanation seems to be that the distribution of stock market prices is non-Gaussian, in which case EMH, in any of its current forms, would not be strictly applicable. Other research has shown that psychological factors may result in exaggerated, statistically anomalous stock price movements, contrary to EMH, which assumes such behaviors cancel out. Psychological research has demonstrated that people are predisposed to seeing patterns, and often will perceive a pattern in what is, in fact, just noise, e.g. seeing familiar shapes in clouds or ink blots. In the present context, this means that a succession of good news items about a company may lead investors to overreact positively, driving the price up. A period of good returns also boosts the investor's self-confidence, reducing their psychological risk threshold. Another phenomenon, also from psychology, that works against an objective assessment is group thinking. As social animals, it is not easy to stick to an opinion that differs markedly from that of a majority of the group. An example with which one may be familiar is the reluctance to enter a restaurant that is empty. People generally prefer to have their opinion validated by those of others in the group. In one paper, the authors draw an analogy with gambling. In normal times the market behaves like a game of roulette, the probabilities are known and largely independent of the investment decisions of the different players. In times of market stress, however, the game becomes more like poker, herding behavior takes over. The players now must give heavy weight to the psychology of other investors and how they are likely to react psychologically. In the period running up to the 1987 crash, less than 1% citation needed of the analysts' recommendations had been to sell, and even during the 2000 to 2002 bear market, the average did not rise above 5%. In the run-up to 2000, the media amplified the general euphoria, with reports of rapidly rising share prices and the notion that large sums of money could be quickly earned in the so-called new economy stock market. Stock markets play an essential role in growing industries that ultimately affect the economy through transferring available funds from units that have excess funds savings to those who are suffering from funds deficit borrowings. Potty and Nake 2012. In other words, capital markets facilitate funds movement between the above-mentioned units. This process leads to the enhancement of available financial resources, which in turn affects the economic growth positively. Moreover, both economic and financial theories argue that stock prices are affected by macroeconomic trends. Many different academic researchers have stated that companies with low P/E ratios and smaller-sized companies have a tendency to outperform the market. Research has shown that mid-sized companies outperform large-cap companies, and smaller companies have higher returns historically. Irrational behavior. Sometimes, the market seems to react irrationally to economic or financial news, even if that news is likely to have no real effect on the fundamental value of securities itself. However, this market behavior may be more apparent than real, since often such news was anticipated, and a counter-reaction may occur if the news is better or worse than expected. Therefore, the stock market may be swayed in either direction by press releases, rumors, euphoria, and mass panic. Over the short term, stocks and other securities can be battered or buoyed by any number of fast market-changing events, making the stock market behavior difficult to predict. Emotions can drive prices up and down. People are generally not as rational as they think, and the reasons for buying and selling are generally accepted. Behaviorists argue that investors often behave irrationally when making investment decisions, thereby incorrectly pricing securities, which causes market inefficiencies, which, in turn, are opportunities to make money. However, the whole notion of EMH is that these non-rational reactions to information cancel out, leaving the prices of stocks rationally determined. The Dow Jones Industrial Average biggest gain in one day was 936.42 points or 11%. Crashes. Robert Shiller's plot of the S&P Composite Real Price Index, earnings, dividends, and interest rates, from irrational exuberance, to ed. In the preface to this edition, Shiller warns, the stock market has not come down to historical levels. The price-earnings ratio as I define it in this book is still, at this writing, 2005, in the mid-20s, far higher than the historical average. People still place too much confidence in the markets and have too strong a belief that paying attention to the gyrations in their investments will someday make them rich, and so they do not make conservative preparations for possible bad outcomes. Price-earnings ratios as a predictor of 20-year returns based upon the plot by Robert Shiller. The horizontal axis shows the real price-earnings ratio of the S&P Composite Stock Price Index as computed in irrational exuberance, inflation-adjusted price divided by the prior 10-year mean of inflation-adjusted earnings. The vertical axis shows the geometric average real annual return on investing in the S&P Composite Stock Price Index, reinvesting dividends, and selling 20 years later. Data from different 20-year periods is color-coded as shown in the key. See also 10-year returns. Shiller states that this plot confirms that long-term investors who commit their money to an investment for 10 full years, did do well when prices were low relative to earnings at the beginning of the 10 years. Long-term investors would be well advised, individually, to lower their exposure to the stock market when it is high, as it has been recently, and get into the market when it is low. A stock market crash is often defined as a sharp dip in share prices of stocks listed on the stock exchanges. In parallel with various economic factors, a reason for stock market crashes is also due to panic and investing public's loss of confidence. Often, stock market crashes in speculative economic bubbles. There have been famous stock market crashes that have ended in the loss of billions of dollars and wealth destruction on a massive scale. An increasing number of people are involved in the stock market, especially since the Social Security and retirement plans are being increasingly privatized and linked to stocks and bonds and other elements of the market. There have been a number of famous stock market crashes like the Wall Street crash of 1929, the stock market crash of 1973-4, the Black Monday of 1987, the dot-com bubble of 2000, and the stock market crash of 2008. 1929. One of the most famous stock market crashes started October 24, 1929, on Black Thursday. The Dow Jones Industrial Average lost 50% during this stock market crash. It was the beginning of the Great Depression. 1987. Another famous crash took place on October 19, 1987, Black Monday. The crash began in Hong Kong and quickly spread around the world. By the end of October, stock markets in Hong Kong had fallen 45.5%, Australia 41.8%, Spain 31%, the United Kingdom 26.4%, the United States 22.68%, and Canada 22.5%. Black Monday itself was the largest one-day percentage decline in stock market history. The Dow Jones fell by 22.6% in a day. The names Black Monday and Black Tuesday are also used for October 28 to 29, 1929, which followed Terrible Thursday, the starting day of the stock market crash in 1929. The crash in 1987 raised some puzzles. Main news and events did not predict the catastrophe and visible reasons for the collapse were not identified. This event raised questions about many important assumptions of modern economics, namely, the theory of rational human conduct, the theory of market equilibrium and the efficient market hypothesis. For some time after the crash, trading in stock exchanges worldwide was halted, since the exchange computers did not perform well owing to enormous quantity of trades being received at one time. This halt in trading allowed the Federal Reserve System and central banks of other countries to take measures to control the spreading of worldwide financial crisis. In the United States, the SEC introduced several new measures of control into the stock market in an attempt to prevent a reoccurrence of the events of Black Monday. Circuit breakers. Since the early 1990s, many of the largest exchanges have adopted electronic matching engines to bring together buyers and sellers, replacing the open outcry system. Electronic trading now accounts for the majority of trading in many developed countries. Computer systems were upgraded in the stock exchanges to handle larger trading volumes in a more accurate and controlled manner. The SEC modified the margin requirements in an attempt to lower the volatility of common stocks, stock options and the futures market. The New York Stock Exchange and the Chicago Mercantile Exchange introduced the concept of a circuit breaker. The circuit breaker halts trading if the Dow declines a prescribed number of points for a prescribed amount of time. In February 2012, the Investment Industry Regulatory Organization of Canada (IIROC) introduced single stock circuit breakers. New York Stock Exchange (NYSE) circuit breakers. Stock market index. The movements of the prices in global, regional or local markets are captured in price indices called stock market indices, of which there are many, e.g. the S&P, the FTSE and the Euronext indices. Such indices are usually market capitalization weighted, with the weights reflecting the contribution of the stock to the index. The constituents of the index are reviewed frequently to exclude stocks in order to reflect the changing business environment. Derivative instruments. Financial innovation has brought many new financial instruments whose payoffs or values depend on the prices of stocks. Some examples are exchange-traded funds (ETFs), stock index and stock options, equity swaps, single stock futures, and stock index futures. These last two may be traded on futures exchanges, which are distinct from stock exchanges. Their history traces back to commodity futures exchanges, or traded over the counter. As all of these products are only derived from stocks, they are sometimes considered to be traded in a hypothetical derivatives market, rather than the hypothetical stock market. Leveraged strategies. Stock that a trader does not actually own may be traded using short selling. Margin buying may be used to purchase stock with borrowed funds, or derivatives may be used to control large blocks of stocks for a much smaller amount of money than would be required by outright purchase or sales. Short selling. In short selling, the trader borrows stock, usually from his brokerage which holds its client's shares or its own shares on account to lend to short sellers, then sells it on the market, betting that the price will fall. The trader eventually buys back the stock, making money if the price fell in the meantime and losing money if it rose. Exiting a short position by buying back the stock is called covering. This strategy may also be used by unscrupulous traders in illiquid or thinly traded markets to artificially lower the price of a stock. Hence, most markets either prevent short selling or place restrictions on when and how a short sale can occur. The practice of naked shorting is illegal in most, but not all, stock markets. Margin buying. In margin buying, the trader borrows money at interest to buy a stock and hopes for it to rise. Most industrialized countries have regulations that require that if the borrowing is based on collateral from other stocks the trader owns outright, it can be a maximum of a certain percentage of those other stocks' value. In the United States, the margin requirements have been 50% for many years. That is, if you want to make a $1,000 investment, you need to put up $500, and there is often a maintenance margin below the $500. A margin call is made if the total value of the investor's account cannot support the loss of the trade. Upon a decline in the value of the margin securities, additional funds may be required to maintain the account's equity, and with or without notice the margin security or any others within the account may be sold by the brokerage to protect its loan position. The investor is responsible for any shortfall following such forced sales. Regulation of margin requirements by the Federal Reserve was implemented after the crash of 1929. Before that, speculators typically only needed to put up as little as 10% or even less of the total investment represented by the stocks purchased. Other rules may include the prohibition of free riding, putting in an order to buy stocks without paying initially. There is normally a 3-day grace period for delivery of the stock, but then selling them before the 3 days are up and using part of the proceeds to make the original payment, assuming that the value of the stocks has not declined in the interim. New issuance. Investment strategies. Main articles: investment strategy, stock market prediction, and investment management. Many strategies can be classified as either fundamental analysis or technical analysis. Fundamental analysis refers to analyzing companies by their financial statements found in SEC filings, business trends, and general economic conditions. Technical analysis studies price actions in markets through the use of charts and quantitative techniques to attempt to forecast price trends based on historical performance, regardless of the company's financial prospects. One example of a technical strategy is the trend-following method, used by John W. Henry and Ed Seykota, which uses price patterns and is also rooted in risk management and diversification. Additionally, many choose to invest via passive index funds. In this method, one holds a portfolio of the entire stock market or some segment of the stock market, such as the S&P 500 index or Wilshire 5000. The principal aim of this strategy is to maximize diversification, minimize taxes from realizing gains, and ride the general trend of the stock market to rise. Responsible investment emphasizes and requires a long-term horizon on the basis of fundamental analysis only, avoiding hazards in the expected return of the investment. Socially responsible investing is another investment preference. Taxation. Taxation is a consideration of all investment strategies. Profit from owning stocks, including dividends received, is subject to different tax rates depending on the type of security and the holding period. Most profit from stock investing is taxed via a capital gains tax. In many countries, the corporations pay taxes to the government and the shareholders once again pay taxes when they profit from owning the stock, known as double taxation. That's all for this video. Thanks for watching. If you like the content, please like, share and subscribe so you could get notified.